I would say they will be coming in. Currently, I'd say 2012 was the year of prime in Germany, and a lot of people were still of the opinion that you should only buy prime and you shouldn't look into these B and C locations, and banks were conservative. And now, as the opportunities for banks to finance prime will not be there, but the transaction market will continue at the high level. Most likely, it's. I mean, I don't have a crystal ball, so maybe it will drop. But at the moment, it looks like, just from the numbers from the first quarter, that the investment activity in Germany is at least at the level of last year and might be growing a little bit. And there will be more product that has to be financed that is not prime. And then I would predict that you would see these lenders looking carefully at these situations, and they might, start negotiating at only a 40% LTV, and then you talk them up. But I think it will happen because they're in the business of lending money.
I think generally capital is extremely nimble. It was the case in the investment market. It's also the case in the debt market. For a number of years, and I'm sorry, I'm going to refer to France again, but for a number of years, the foreign buyers have made the most of the acquisitions in France, 96 to 2005, roughly. And then market players thought, okay, when they retreat, what happens? Well, you figure there is enough capital throughout the globe, and each investor is through a different cycle of its own diversification play and portfolio buildup. And when a market or when a population retreats, there's always another one. If your market is attractive enough, there's always another pocket that finds the opportunity and comes at you. And I think that is happening on the debt market as well. One thing we have to remember is when money was cheap in 2005, or up until 2007, it was only the margin that was cheap. If you swapped over 5 or 7 years, you had cost of financing that was well in excess of 5%. If today you think money is not cheap, it's only because margins are now 300 to 400 basis points in the riskier or perceived as riskier areas, but your base, 80 basis points for a 5-year swap, 110 for a 7-year swap. Overall, the cost of debt has probably shrunk in that period. And that is also making it more interesting for lenders because they recover some of their losses through renewed profit with increased margins. And those who can extend, we talked about the CMBS market, that's a lender that cannot indefinitely extend, whereas a bank can. And a bank will extend to the point where it's recovered through profits. It's recreated equity with a 3% margin as opposed to 75 basis points 5 years ago. So as the monetary easing remains as it is, it will be a very profitable business for banks, even to take marginally higher risk. So I think because capital is nimble and there's a benign interest rate environment, banks will move more quickly in their risk spectrum, in their whether location or loan to values or sponsor types, very, very rapidly.